A mutual fund is a type of collective investment that collects the money of many investors to buy a number of securities like stocks or bonds. When you buy a share in a mutual fund, you own a small portion of the fund's investments. Consider a mutual fund to be a bundle of investments. When you buy a mutual fund share, you are purchasing one share of this bundle and thereby have a stake in a small portion of the fund's investments. Mutual funds have the power to assist investors in a variety of ways. They are a strategy to diversify your investment. The majority are handled by financial professionals. Furthermore, due to the vast range of mutual funds available, investors can engage in a wide range of investment types. Let's look at an example of the way a mutual fund operates. Assume an investor wishes to invest part of his retirement funds in the stock market but lacks the time to research individual stocks and build a diverse stock portfolio. Instead, he decides to invest in a mutual fund. This allows the investor to buy a single investment that is equivalent to buying a complete portfolio of stocks. So which mutual fund should he invest in? He uses internet resources such as mutual fund searches and ratings provided by independent third-party organizations to choose a mutual fund that fulfills his investment objectives. When he discovers a fund that appears to be a good fit, he reads the prospectus, which is the official description and presentation of how the fund works. The prospectus contains a wealth of information about the fund, such as its fees and charges, minimum purchase amounts, performance background, risks, and other relevant information. After reviewing the fund and its prospectus, our investor concludes that it appears to be a solid investment. As a result, he invests the least amount necessary and buys mutual fund shares. By purchasing shares, the investor is now involved in the profits and losses of all firm fund transactions. Let me know in the comments if you have any other questions about investing. Let's return to the video. Diversification, which occurs when an investment or portfolio is distributed over multiple different investments, is the benefit of this. This can assist to reduce risk. For example, if one of the fund's investments has a bad year, the effect on the fund's overall assets may be minor, because that struggling firm represents only a small portion of the fund's total assets. The fund chosen by the investor, like most other mutual funds, is actively managed, which means it is handled by a fund manager or managers who purchase and sell the fund's assets. Fund managers use financial research and professional knowledge to give the best possible returns to investors. Although a talented manager may achieve significant returns for the investor's money, success is not guaranteed. If a management makes poor decisions, our investor will not receive the expected profits. Even if the fund underperforms, the management is still paid a charge, which is deducted from the fund's assets, resulting in even lower returns. Management fees are not the only expenses our investor must face. Aside from transaction costs, the fund may levy a sales load, which is a fee to acquire or sell shares. Some funds also charge a fee if shares are sold within a certain time range. Now that an investor has invested in a fund, how can he profit from it? One method would be through appreciation, which occurs when the value of the fund's shares rises. Usually, when the fund's assets increase in value, so do the fund shares. The value of the fund shares, unlike stocks, does not fluctuate throughout the trading day. Instead, after the market closes, the fund's value is determined and updated. A dividend payment, which occurs when a mutual fund distributes a portion of its gains to shareholders, is another method an investor might profit from a mutual fund. However, as the fund's assets decline in value, so do the fund shares, which is a risk of investing in a mutual fund. One advantage of mutual funds is the wide range of mutual funds accessible. Our investor picked a stock investment mutual fund. However, a mutual fund exists for practically every sort of investing. Equity funds, for example, invest in stocks, while fixed income funds invest in bonds and balanced funds invest in both. Several mutual funds may invest in an entire index, whilst others may concentrate on companies from a specific country or market sector. Certain funds also have diverse goals. Some investors may seek out riskier equities in rising industries, while others may prefer to invest in more stable corporations. There is a lot to know about mutual funds and other investing alternatives, and we have other videos to assist you.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching.
Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.